As we saw earlier, stock markets were relatively stable today, but the shock of Monday's fall is still echoing. So lots to talk about with the Bottom Line panel. Preet is away, but Patty, Jim, and Amanda are here. But first, a brief recap. The market mayhem was sudden and dramatic. From Asia to Europe to New York and Toronto, the sell-off rattled investors large and small. Stock exchanges down hundreds of points. Losses in the trillions of dollars. Snap decisions from millions of people. Some on educated guesses, others on pure emotion. In the end, lots of losers, but there were winners too. And while today is calmer for Canadians with an October vote on their minds,
the economy,
our economy,
the economy,
some urgent questions persist, starting at the start with Monday morning itself. So let's get some answers. And Patty, let's start with you. A lot of people wondering what happened and why.
Well, Ian, basically what happened on Monday is we went from complacency to panic in a heartbeat. And the catalyst for that was China. The Chinese stock market has been selling off last week. And on Monday, investors thought the Chinese government would do something to soften the blow. They didn't do anything. That caused disappointment. China's stock sold off. It rippled across into Asia, the Middle East, Europe, and on into North America.
Jim?
One of my favorite economists, John Kenneth Galbraith, Canadian, says a punctured balloon never deflates in an organized manner. And that's kind of what happened as well. It is a lot of emotion in these markets. It alternates between greed and fear. And on Monday, it could have been any proximate cause, but it was concerns about China, as Patty says. Fear won out, and that's what caused the big drop.
And it's worth noting that people have been calling for a long time for some kind of sell-off in stocks if there was any place to go. The thing that's interesting about stock markets is usually there's an alternative to put your money into. At the moment, there isn't. So they've stayed buoyant longer than a lot of people thought they should. A lot of people saying we were due for a correction. It just needed the catalyst.
And any surprises to you with the way things happened, particularly Monday, Tuesday, Amanda?
The most surprising thing to me, actually, on Monday was just the extent to which the systems didn't work the way you want them to work. The trading itself was odd. Prices gapped up and down, so stocks were halted because of the speed at which they were falling. And I'm not sure that the exchanges, in hindsight, will be seen to have been able to manage this as well as one would hope.
So the headline for those 2 days in particular was the loss in value of these on these various indexes. But there were some people, Patty, that made a lot of money.
That's right, and that's kind of counterintuitive because I think when you think about the stock market, you think about buying a stock, allowing it to increase in price, you take your profit. That's called going long a stock. But there is a strategy that's the flip side of that, which is going as short a stock, which means you anticipate that the price is going to decline, your position for that, and you can actually make money. And that happened on Monday in spades. It can be done by individual investors, can be done by hedge funds. It's called a long-short strategy, but it's a very risky strategy, but it can be very lucrative as well.
It's interesting, though, you mentioned it's risky. I'm sure there's some people who would sit back and go, oh, okay, it's those people who profited on the Monday and Tuesday who were kind of pulling the levers here. Were they driving this, or were they?
Absolutely not. No, there's been, as Amanda mentioned, people have been calling for a correction for some time. Usually you get a correction in a bull market, which is when stocks go up. You get a correction about every 12 to 18 months. We've been 4 years without a meaningful correction, so it was long overdue. You never know what the catalyst is going to be, but you do know it's unpredictable and very, very sharp when it happens.
And let's get back to that issue of who walked away on Monday or Tuesday feeling pretty good, making lots of money.
Well, you know, Ian, I think you have to take these paper valuations with a big grain of salt. You know, you could say the value of all these pieces of paper traded on the world's stock markets fell by $10 trillion, but it's not money. It wasn't money in the first place. Was it really worth that much in the first place? Probably not. And unless you cash out at that moment, then you actually didn't lose money. That's why the traditional advice is you shouldn't try to time the market. You should hang on to it. That's what they say to individual investors, of course. The pros are in there like anything, you know, buying and selling, high-frequency trading, trying to time the market. But for average individual human beings, that doesn't make sense. So these paper valuations, whether they're rising or falling, aren't really accurate.
But they do have a psychological effect, though, those paper losses. When you see that headline, $5 trillion of losses, that is startling.
And there is another actual fundamental change, which is, and this probably won't know for a while to what extent this happened, but a lot of companies have share buyback programs, and when they buy in their stock, it actually does make their profit per share higher. Everybody wins. And I think a lot of that was going on because they would have actual price targets. And you saw a lot of this was computer driven. Stocks hit levels and then the buying started. And that ultimately actually will be good for other investors, big and small.
So we had that was going on Monday, Tuesday, but I think it would be really helpful to get in behind those numbers, those headlines that got thrown at us earlier this week. And so what else was going on as we saw those share prices go down?
So we are so computer driven now that it's important to remember that we still sort of think of stocks as people in an open outcry system saying, you're yelling your price and I'll yell my price. The computers really do run this. And so there's a whole bunch of program trading that was kicking in. When the halts happened, so I couldn't buy and sell on the New York Stock Exchange, there's a bunch of other places where it was still being traded by the biggest investors. So the pricing gets really driven by these automatic programs, which may be better, it may be worse. It certainly kept the volume moving.
But I think what happened on Monday as well, Monday was all about panic because what we saw was indiscriminate selling. So that means if it was a good stock or a bad stock, if it was a commodity, a currency, if it was in Europe, Canada, the United States, everyone sold as everyone tried to get to the exit. So that was Monday, pure panic. But very importantly on Tuesday, what we saw was the long-term investors came back into the market and fundamentals began to take hold once again. So what they saw is companies that were now significantly cheaper than they had been just a few days ago, and they were big buyers. So that's the difference between Monday was panic, Tuesday was about fundamentals.
But here's something I don't understand about panic, emotion, anxiety, words that I heard a lot on Monday and Tuesday, especially that word panic, is that if you have the big institutional investors who presumably are sophisticated and I would hope aren't prone to panic, and if they have a huge influence on the market, then who was panicking and why was that driving what was going on?
Well, I think institutional investors, for the most part, kind of went along with the ride because, as Amanda mentioned, a lot of this is driven by programs that set off targets, and once those are reached, they sell, and the market builds momentum on itself. So I think the institutional investors, for the most part, were kind of standing on the sidelines, waiting for things to calm out and then take advantage of opportunities.
It's important to remember, too, that we've had 4 years of incredible gains on markets, and so if you're sitting on 4 years of run-up, it wasn't a bad time for you, the biggest investors, to say, let's lock in those gains today because we don't know what's going to happen and buy back at a lower price. And there was probably a lot of that going on. When you see those wild swings, that's savvy money managers doing exactly that.
Yeah, because on Twitter, they were calling this Black Monday, but to me, this was light gray Monday. Black Monday was an over 20% decline in stocks. On Monday, what we saw was a 4% decline, so keep that in mind as well.
It didn't even rank in the top 20 market meltdowns in history. So if you're going to play the stock markets, this is the kind of thing you have to get used to.
Jim, I'm kind of curious when you hear, given what you said about how a lot of this is just paper, you know, and if you just hang on for a while, it'll all even out. When you see all the coverage, all the conversation, not here, of course, but elsewhere, about what happened on Monday and Tuesday, does that frustrate you?
I think we do give it too much attention, frankly, Ian. I think people look at the stock market as if it's some kind of barometer for the real economy, and it absolutely isn't. It isn't reflective of the real work and production that goes on in our economy. It isn't even a source of real capital anymore. It used to be the stock market was where businesses were supposed to raise money to finance their growth. That isn't how it works. Amanda was talking about share buybacks. There's actually more money that's pulled out of the stock market that goes in than goes in. So it really is a speculative casino. I'm not saying there aren't any effects from it, but the attention that it's given and the extent to which we even invest our social programs in it, our pensions. You know, if we've got these pointless up and downs over time, is this indeed where we should be investing those types of programs?
But I think what happened on Monday, though, is that people are now recalibrating the outlook for global growth. They're coming to grips with the fact that China is going through tectonic changes. They're trying to move from export-led growth to consumer-led growth. And what that means for countries like Canada is that commodity prices are likely to stay low for a long period of time. We now live in a world where the price of crude oil is below $40 per barrel, and that has everything to do with China, and that's what the markets are pricing in.
But we've known that for months. That didn't all happen on Monday.
We're seeing the reality of it. But to Jim, I agree with you that the paper moves can be overblown, especially for individuals. Feeling badly about the decline you saw Monday, if you don't have to sell your stocks, ignore it, look again in a year, see what's doing. Having said that, the markets are one of the greatest wealth creators for pension funds, for individuals, and we shouldn't poo-poo that. It is a way to increase the value of your investments, and if you can access it, it's a great thing over the long term.
But if you don't have real prosperity, real growth, real investment, real incomes behind it, an inflated stock market in and of itself is no guarantee that you're prosperous, particularly when it's driven up by credit. Here's if you think of the stock market as the bubble, the air that's being pumped into the bubble is credit that's created by the banking system. And instead of being used to finance real businesses as investment, which we haven't seen, it's used to buy up stocks. And that's, in a way, the most damaging aspect, is the fact that it gets so inflated.
Well, it's the collateral damage of having easy monetary policy for far too long.
Exactly.
I want to quickly talk again, and we've mentioned it a couple of times, about China before we go. Is this a correction we've seen in China? Are things stable? Do we have any idea if China drove the beginning of what turned into panic on Monday, what is China going to do, Amanda, over the next few weeks or months?
So the real fear is not that China is slowing. We've known China is slowing. So there's a reality and a reset. And for commodity-driven economies, it's a real one for a long time. The fear is that there's things we don't know about China, and that China isn't actually doing a very good job of managing. And that is its own banking system, a credit crisis that could emerge. That's the worst-case scenario, that it could actually trigger a real kind of global contagion. Best case, it's a slower growth, and we all learn to live with it.
It's going to be a very bumpy road as China does transition to consumer-led growth. But I think what's happening now is the engine of growth in the world economy is switching from China to the United States. I think that's the best hope for Canada, because U.S. growth is domestically driven. Chinese exports are 1% of the U.S. economy. They don't care if China slows. So for Canada, what we do care about is a cheap Canadian dollar and a stronger U.S. economy. And I think that's what's happening.
A few years ago, hitching our trailer, I guess, to China's second biggest economy in the world, all this potential growth seemed like a good idea. Jim, were we wrong, or should we at least change that strategy now?
Well, it seemed like a good idea to some people, Ian, that the idea that China was going to grow at that pace forever and resource prices can only go up and never down. I think anybody with historical perspective knew that story was wrong. And now that we've seen what's happened, it clearly is wrong. This is the time for us to diversify our economy now.
Well, it's always nice watching all of you discuss these things. It's even nicer to be standing here involved in the conversation. Thanks to all of you.
Thank you, Ian.
Thank you.